Let's pause for a moment, because what just happened is being misread by almost everyone following the news. This is not really a story about Venezuela, and it's not about Maduro as an individual. What we just witnessed was a trigger, a spark that released pressure inside a system that had already been stretched to its limits. If you see this as just another sanction or another regional dispute, you're missing the real signal. When the United States moved against Venezuelan oil flows, it wasn't acting locally. Oil is never local. The moment a producer is constrained, the shock ripples outward through shipping lanes, insurance markets, trading desks, and national balance sheets. This action didn't stop in Caracas. It traveled across oceans and landed exactly where it mattered inside China's energy supply chain. Venezuela was not the target. Venezuela was the lever. For years, discounted Venezuelan crude flowed quietly into China, absorbed by refiners willing to price in political risk in exchange for margin and stability. That oil wasn't just fuel, it was predictability. When Washington tightened control over Venezuelan exports, it didn't just pressure a sanctioned regime. It disrupted an input Beijing had already integrated into long-term planning. At that moment, the issue stopped being regional and became structural. This is how modern economic pressure actually works. No tanks, no announcements, just uncertainty. Tankers hesitate. Insurers raise premiums. Traders step away. Time turns into cost, and cost turns into avoidance. You don't need to shut the system down. You only need to make participation irrational. The mistake most observers are making is assuming the pressure ends here. It doesn't. This was never about punishment. It was about signaling control over movement, energy, and tempo. And when a major industrial power sees its inputs threatened, it doesn't react emotionally. It recalibrates. What follows is not chaos. It's strategy. If you want to understand where markets are really heading, you have to understand moments like this as signals, not events. If this perspective helps you think more clearly about markets, type 1 in the comments and let me know what asset you're watching. And subscribe, because the next phase of this story is where the real consequences begin. Once Venezuelan oil flows slowed, the consequences didn't arrive dramatically. They arrived quietly through mechanics most people never see. Oil doesn't move simply because it exists. It moves because insurers are willing to underwrite risk ports, guarantee access schedules remain predictable, and delays stay manageable. Remove even one of those pillars and friction appears. Remove several at once and the system begins to seize. By signaling tighter scrutiny over Venezuelan waters, the United States didn't need to stop every tanker. It only needed to inject enough uncertainty to change behavior. Shipping companies operate on thin margins. A single day of delay for a large crude carrier can mean tens of thousands of dollars in losses. Add inspections, rerouting, or idle waiting, and the math stops working. Participation becomes irrational long before force is ever applied. The result is self-reinforcing. Ships turn away before they are challenged. Traders cancel contracts before penalties are discussed. Insurers quietly raise premiums or withdraw coverage. What looks mild on paper becomes powerful in practice. This is how enforcement works in the modern system. Not through constant intervention, but through incentives, fear, and risk repricing. Inside Venezuela, the effects were immediate. Production didn't fall because wells ran dry. It fell because storage became the bottleneck. When exports stall, tanks fill. When tanks fill, production must slow. Oil cannot be stockpiled indefinitely, especially in an infrastructure already weakened by underinvestment. By targeting exit points instead of wells, pressure multiplied with minimal direct action. But the real significance wasn't inside Venezuela. Every barrel that failed to leave was a barrel that failed to arrive somewhere else. And for China, that absence mattered far more than headlines suggested. Chinese refiners don't operate opportunistically, they plan. Their margins, configurations, and forecasts depend on predictable flows. Venezuelan crude, heavily discounted, had become part of that planning. When shipments slowed, it wasn't an inconvenience. It was a disruption to cost structures and energy security assumptions. And that's the moment where pressure aimed at one country quietly becomes pressure on another. This is where the story shifts, because when supply security is threatened, the response doesn't stay in the energy market. It looks for leverage elsewhere. From Beijing's perspective, this moment wasn't shocking. It was clarifying. It confirmed a risk Chinese planners have understood for years, but could no longer ignore. Physical supply chains, especially energy, remain exposed to American power in ways that contracts and diplomacy cannot fully protect. When oil moves by sea, it moves through a system the United States can influence without firing a shot. China knows a symmetrical response makes no sense. Matching naval power ship for ship would be slow, expensive, and dangerously escalatory. That path offers little leverage. Instead, Beijing looks for asymmetry. It looks for areas where pressure can be applied quietly, persistently, and at lower cost. This is where the response begins to move away from oil itself. The realization is simple, but profound. If physical flows can be squeezed, dependence on them becomes a strategic vulnerability. And once a vulnerability is exposed, it must be reduced. That process starts with reassessment. Where are the choke points? Which inputs are politically fragile? Which assumptions no longer hold under pressure? For China, energy security is not about headlines. It's about predictability. Refineries are configured over years, not weeks. Supply disruptions cannot be solved instantly without margin loss and efficiency drag. When Venezuelan shipments slowed, planners weren't reacting emotionally. They were studying precedent. If this can be done here, it can be done elsewhere. This is where the shift accelerates. Oil is the trigger, but finance is the response. Beijing understands that while the United States dominates sea lanes, it is far more exposed in markets. Naval enforcement is costly. Presence requires funding, borrowing, and political cover. Those costs accumulate. The Venezuelan episode showed strength, but it also revealed strain, and strain is where leverage quietly changes hands. This is the moment the confrontation begins moving away from tankers and toward balance sheets. Once the focus moves from ships to strain, the logic becomes clear. The United States can project pressure across oceans, but that power is never free. Naval patrols, inspections, and sustained presence all carry a cost. That cost doesn't dominate headlines, but it accumulates quietly inside budgets, deficits, and debt issuance. Physical dominance always comes with a financial bill. From Beijing's perspective, this is the key asymmetry. Washington applies pressure through presence. Presence requires funding. Funding requires borrowing. And borrowing increases exposure to markets. Each enforcement action adds weight to a fiscal structure that is already under stress. China doesn't need to confront this power directly. It only needs to let the costs compound. This is why the response does not come at sea. It comes through observation and timing. Energy disruptions feed volatility. Volatility feeds inflation expectations. Inflation pressures policy. Policy tightens financial conditions. The chain reaction is familiar and markets recognize it quickly. What changes here is perception. Higher yields no longer signal confidence alone. They begin to signal strain. Rising borrowing costs reflect the price of maintaining global control. This is where physical power intersects with financial vulnerability. China understands that markets move faster than fleets. Capital reacts before policy adjusts. Confidence shifts gradually, then suddenly. You don't need to block access. You let participants reconsider assumptions. Over time, behavior changes. The Venezuelan episode makes this visible. It shows that supply chains can be disrupted and that disruption carries a cost for the enforcer as well. Once that connection is clear, the confrontation stops being about oil volumes and starts being about sustainability. And that shift quietly prepares the ground for the next phase. As Venezuelan oil exports tightened, global markets began to adjust before shortages ever appeared. Oil markets don't wait for missing barrels, they reprice risk. The perception of fragility matters as much as the reality of supply. When shipments slow and enforcement intensifies, traders factor in geopolitical premiums. Volatility rises. Prices respond not to what is gone, but to what might disappear next. This matters because energy prices feed directly into inflation expectations. Even modest disruptions ripple outward through transportation costs, production inputs, and consumer pricing. Markets begin to anticipate tighter conditions. Central banks are forced to weigh stability against control. A regional enforcement action quietly starts influencing interest rate assumptions far beyond its origin. At the same time, enforcement becomes more complex. Shadow fleets expand. Ships change flags, ownership structures blur through shell entities. Tankers alter routes, registries, and paperwork to slip through gaps. Each maneuver raises the risk of error. A misidentified vessel, a wrong inspection, a third party pulled into a dispute it never intended to join. As this cat-and-mouse game intensifies, costs rise on all sides. The United States spends more to maintain presence. Shipping companies absorb higher insurance premiums. Traders demand wider margins. These costs do not vanish. They accumulate and flow through the system, tightening financial conditions further. From China's perspective, this reinforces a critical lesson. The United States can enforce control, but doing so is expensive and destabilizing. Every additional layer of enforcement adds friction to global markets. That friction feeds back into the enforcer's own economy through higher costs, higher yields, and greater fiscal strain. This is why the situation escalates beyond oil. Energy is only the entry point. The broader effect is a repricing of global risk. And once that repricing begins, it does not remain contained. It spreads across assets, across borders, and into the core of financial markets. That spread is what transforms pressure into something much larger. By this stage, the confrontation has fully left the physical realm. The ships still matter, the oil still matters, but they are no longer the center of gravity. What matters now is exposure. The Venezuelan episode forces a recalculation of how much leverage physical enforcement really provides once financial consequences are included. From Washington's side, the logic remains straightforward. Control movement, restrict flows, apply pressure. But markets interpret this differently. They see enforcement translating into higher spending, wider deficits, and heavier borrowing needs. Each new operation adds marginal strain. Over time, marginal strain compounds into structural pressure. This is where China's strategy becomes clearer. Beijing does not need to counter the blockade directly. It needs to position itself for the second-order effects. As U.S. borrowing increases, the system demands higher yields. Higher yields attract capital in the short term, but they also signal rising risk. Debt servicing costs grow. Fiscal flexibility shrinks. Confidence becomes more conditional. China understands that confidence is the true foundation of financial power. It cannot be seized or enforced. It must be maintained. When investors begin to question sustainability, even subtly behavior shifts. Allocations adjust. Hedging increases. Diversification accelerates. None of this looks dramatic at first. This is why the response remains quiet. No announcements, no ultimatums, just preparation. Beijing watches how quickly pressure on oil feeds into volatility elsewhere. It notes how sensitive markets are to disruptions that expose cost rather than control, and it adjusts its own posture accordingly. At this point, the confrontation is no longer about who can block a shipment. It is about who can absorb strain longer without destabilizing their own system. That is a very different contest. One fought over time, credibility, and balance sheets rather than force. This is the inflection point. Once markets begin to internalize these dynamics, the next phase becomes unavoidable. What follows this inflection point is not escalation, but repositioning. Beijing begins shifting focus away from defending physical flows and toward reducing dependence on the system that makes those flows vulnerable. This is not emotional, it is arithmetic. If access can be constrained, reliance becomes a liability. The adjustment starts quietly. Exposure is reviewed. Long-term assumptions are stress-tested. How much risk sits in routes that can be delayed or monitored? How much cheap supply depends on political isolation. Under pressure, discounts reveal hidden costs. At the same time, China observes the other side of the equation. The United States can enforce control, but each enforcement carries a burden. Borrowing rises, debt issuance expands, yields climb not just on growth but on risk. Markets begin to connect pressure abroad with strain at home. Confidence does not collapse. It shifts. Investors rebalance rather than exit. Diversification becomes prudent, not ideological. Small adjustments accumulate quietly, reshaping market structure over time. This environment creates an opening, not for confrontation but for an alternative posture. Stability, Predictability, participation without enforcement, risk attached. This does not require announcements, it requires consistency. The Venezuelan oil squeeze makes one thing clear. Access is conditional. Once that realization spreads, adaptation becomes rational. And once adaptation begins, it is very difficult to reverse. This is where currency quietly enters the picture, not as a headline event, but as a signal. China does not announce a currency confrontation. It never needs to. Instead, it allows markets to see what it is willing to tolerate and, just as importantly, what it is no longer willing to suppress. That subtle shift carries more weight than any declaration. For years, Beijing managed its currency to favor exports, absorbing criticism in exchange for growth. But when access itself becomes uncertain, cheap exports matter less than resilience. Allowing the currency to strengthen reframes the equation. It signals confidence, it attracts capital, and it changes the balance of leverage without blocking a single ship. A firmer currency does several things at once. It draws global investors toward Chinese assets at a time when U.S. markets are weighed down by deficits and heavy issuance. It weakens long-standing accusations of manipulation, softening political resistance among trade partners. And it increases purchasing power abroad, making real assets more accessible. Markets respond quickly to credibility. Capital flows test the signal. Bonds attract interest. Equities stabilize. Each response reinforces the next. The process does not need speed. It needs persistence. Over time, participation grows because the risk-reward balance quietly shifts. From Washington's side, this dynamic is difficult to counter. You cannot sanction confidence. You cannot blockade capital without destabilizing your own system. Higher rates offer temporary support, but they deepen fiscal strain. The tools available are blunt and their side effects are severe. The Venezuelan oil disruption accelerates this shift by forcing attention away from barrels and toward balance sheets. What looks like an energy squeeze becomes a financial signal. And once markets receive that signal, the adjustment process begins to move on its own. As currency dynamics shift, the effects extend far beyond exchange rates. Capital never moves in isolation. When expectations around stability and sustainability change, portfolios adjust. Large institutions do not need dramatic exits to alter the landscape. Small reallocations are enough to move yields, liquidity, and policy reactions. This is where pressure feeds back into the real economy. Higher U.S. yields no longer signal strength alone. They reflect the cost of financing deficits tied to enforcement and global commitments. Each rate hike supports the currency briefly, but it also raises debt servicing costs and tightens domestic conditions. The trade-off becomes increasingly visible. China's posture exploits this tension. A stronger currency lowers import costs, easing inflation at home and freeing capacity for investment. It also increases purchasing power abroad, making long-term assets more accessible. These are not tactical moves, they are structural. At the same time, trade behavior evolves. Companies seek insulation from volatility. Settlement choices diversify quietly, contract by contract. No announcement is required. Incentives do the work. The irony is clear. Pressure meant to assert control accelerates the search for alternatives. As options expand, leverage fades. By now, the confrontation no longer plays out at sea. It unfolds in balance sheets and expectations. And once those shift, momentum takes over. This is where everything comes together. What began as pressure on a sanctioned producer was never about oil alone. It was about how power is exercised when traditional tools become expensive and increasingly visible. The Venezuelan episode did not create a new confrontation. It exposed one that had already been forming beneath the surface. The lesson is not that the United States is weak or that the dollar is about to collapse. That narrative is too simplistic and usually wrong. The real lesson is that leverage has a cost, and those costs compound. Physical control over supply chains delivers short-term influence, but it also accelerates financial strain. Over time, that strain feeds back into markets' confidence and policy flexibility. China's response illustrates the shift. Not retaliation, but adaptation. Not spectacle, but structure. By moving the contest into currency, capital flows, and incentives, Beijing chooses a battlefield where patience matters more than force. This is not a fight that produces winners overnight. It produces gradual realignments that only become obvious in hindsight. For investors and traders, this environment demands a different mindset. Volatility is no longer just cyclical, it is structural. Old assumptions about safe havens correlations and dominance need to be questioned. Risk is no longer confined to emerging markets. It lives inside the core of the system. The opportunity lies in understanding these transitions early, in recognizing that markets move on incentives, not headlines, in positioning for shifts in capital currency and confidence rather than reacting to noise. This is not about fear, it is about clarity. If this analysis helped you see the bigger picture, support the channel by liking the video, subscribing, and sharing it with someone who cares about markets beyond the surface. And leave a comment below about what you think the next pressure point will be. Because in this environment, the most valuable edge is understanding where the battlefield is moving next.